Hello, listeners, and welcome back to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. Before we get to my weekly chat with Rob about geopolitics and markets, I just want to take a minute or two to talk to you about some exciting news that's happening at CI. As you probably know, I promise there are never going to be ads on this podcast as long as I'm the one who's hosting the podcast. That's not really what I'm interested in. But one of the things the podcast does allow me to do is share exciting things that we're doing at CI. You might know that CI is primarily a wealth manager, so we interact with individual clients and help them manage their portfolios. But we've also had a lot of interest from people who didn't necessarily want access to those wealth management services, but wanted to know, how do you do all this research? How do you generate all these insights? How can I get access to some of the things that you are seeing in real time? And we took that feedback seriously, and what we've done is we've made our quote-unquote knowledge platform, which is the internal name we use for our geopolitical research and our disruptive innovation technology research. We've made that available to potential subscribers who want access to that information, but who don't necessarily or are not necessarily interested in our wealth management services. There's a link in the description to this podcast where you can find out more information about those research services. I expect that many of you will not be interested in them. You may just want this free podcast to know things about the world a little bit better. You'll continue to read the Global Situation Report, which will continue to come out each week. But we know that there's a significant subset of you who are either in the context of your work, or if you're super interested and nerdy about these types of things, or building your own portfolios, that want access to that research. And so we've enabled that access. And you can pick geopolitics, you can pick innovation, whatever you want. There's an a la carte way to do it. There's also options. A select number of clients can also interact directly with me if they have concerns about supply chains or want some more hands-on things. But all the information is on the website. If any of that sounds interesting to you, please go to that link, or you can write to me at jacob@cognitive.investments directly. Rob and I spend the first 15 or 20 minutes or so in the podcast talking about the knowledge platform, but also just talking about why geopolitics and why disruptive innovation are the things that we're focused on, and giving you that sort of macro perspective on those frameworks. So I hope you enjoy that. I hope if you're interested in that, you'll reach out or you'll check it out online. Otherwise, thank you again for bearing with me over the past couple of weeks. It's been honestly a difficult couple of weeks for me personally, but I'm back in action. I'm back at my desk. I'm not traveling anywhere for 7 weeks, and we'll get back on the podcast cadence. I already have some of your favorite guests lined up for the next couple of weeks, and some new interesting guests who are slated to come on. So without further ado, cheers. See you out there. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. Rob, we're back at it. I've been some listeners to the podcast might know that a couple months, I guess it was a year ago now, I discovered some documents in my dad's basement that pertain to my grandparents and their flight from the Nazis. And anyway, it might mean citizenship for me in a European country. I'm like, I was looking through some of those documents over the past couple of days and realizing what a weenie I am, and like how good we all have life right now. I was in Atlanta, or I was in Georgia last week. I brought the 8-month-old to see my dad, and I'm like freaking out and stressed about, I got to get the 8-month-old on the plane, and we got to get from got to get her in the stroller and get the car seat, point A to point B. I'm looking at my grandfather's documents. He was like putting a 3-month-old on a ship to cross the Atlantic with no state papers, like a stateless human who had no idea what he was doing, writing to different consulates in all sorts of different languages. And here I am, like, worried about the car seat. So that's my way of saying life's pretty good right now, y'all. I know it might not feel that way if you look at the headlines, but compared to where we've been, things are going well. And that's how I at least wanted to start out. How are you doing?
Well, we always do make the optimistic case on this podcast, so that's good.
Do we? I feel sometimes the content itself is too doom and gloom, but I guess we're at least a little more sober than the rest of the people, at least when we're recording. Before we dive into what's been going on over the past couple of weeks, you and I missed last week because I had some things pop up. But it's been an exciting week for us at CI. And while I always say that we're not going to put any ads in the podcast, we're now going to do a little bit of talking about ourselves and what we've been doing on the off chance that you might want access to some of our research. So this past week, we've been testing this for a while. We've been talking about it for a while. We talk about it on the podcast all the time. We rolled out access to some of our research because some people out there, for whatever reason, you trust your financial advisor already. You don't have, your account is too small to warrant, some of the services that we provide. Some people wanted access to our research without actually wanting to become clients of the money management side of the business. And there was enough interest there that we had to say, okay, how do we do that? And we've spent the last couple of months very intentionally thinking about how to structure that, how to put it behind a paywall, how to figure out sort of all those, brass tacks out. And this week we finally rolled it out. So Rob, I think I might just turn it over to you there. What do you want the listeners to know about the Knowledge platform?
Well, there's a lot there. I guess to start with, our wealth management clients have gotten access to the Knowledge platform from day one, even when it was a very nascent thing. And this new development is essentially a way to bring the Knowledge platform to corporate or investment manager clients or individuals who really have a strong need for research and information. But essentially, what is the Knowledge platform? It is our database and our dashboard of everything that we're analyzing and seeing. It's a guide to what's going on in the world that we use internally, and really in two different silos. The first is geopolitics, which we talk about all the time, obviously, on the podcast. And the second is disruptive innovation, which is a new area. We've sort of hinted at this a little bit, but this is a major area where we've been focusing. And just now we're starting to reveal some of that work that we've done to the world. So disruptive innovation and geopolitics are the two sides, but they also connect to each other in a very important way. And maybe do you want to explain what that way is? Like, why geopolitics and disruptive innovation? This isn't just a random pairing of things, right?
Yeah, well, I mean, the example I always use when I'm speaking to audiences is the US semiconductor industry, but we can talk about a few others. But if you go back to the 1950s and 1960s, this is the height of the Cold War. It's the height of the Red Scare in the United States. It's the white knight of capitalism versus the evil communist ogres and things like that. But the U.S. government basically stands up the U.S. semiconductor industry by becoming the largest client of these various different semiconductor companies. It's not very capitalistic the way that the United States government went about doing that. And the reason the United States government did that was not so that you and I could record these podcasts, or so that was not so that you and I could record these podcasts, or so that listeners could send TikTok videos to each other that make them laugh. It was so that U.S. missiles that were going to strike targets in the Soviet Union could be more accurate. And everything that comes afterwards with semiconductors happens because the United States government basically funded the startup of that industry for that very explicitly geopolitical need. That might feel dirty to listeners a little bit, especially because technology and tech entrepreneurs have cloaked themselves in this garb of, I don't know, moral purity, like they're going to be the future of the world and everybody's going to be connected and geography is not going to matter anymore and we're all going to overcome all these things that have defined human civilization for centuries. Not really. And when you actually look at sort of the core of disruptive technologies like this, the countries that are able to have that first position in them do well geopolitically, and then the companies and investors that can identify those places where you're going to have disruptive technology, that's where you can get the largest returns. So trying to find those concentric circles between, okay, well, what's important geopolitically and what is important from a tech basis that is changing every day is kind of why those two things line up. And I know that it can sound kind of amorphous, like the knowledge platform and a database and things like that. But what I want listeners to have in their minds is, imagine you can open up a stream of everything that's going on in the world geopolitically. I'm on there every day, and some of our other analysts are on there every day, sifting through all of the different things that are happening in the world. And we're picking the 20 or 30 things you need to know and telling you, hey, this is what we think about this. Or sometimes we're telling you, hey, this was completely unexpected. We have to drop everything we're doing right now and look at this. And we're also doing that from the tech perspective. And in some ways, it's more important to do that from the tech perspective. I think like electric vehicles is a really good example of this. Everybody's talking about electric vehicles today. Everybody says that electric vehicles are going to be the new thing. We have no idea if electric vehicles are going to be the new thing. We don't even know what kinds of batteries are going to go into different types of vehicles or other products around the world, because research on battery technology is changing every single day. So if you think you know something that makes you think that lithium is going to go to the moon in the next 5 years, maybe that's possible. But on our innovation dashboard, what we're going through is finding, all the reports in the obscure journals around the world, not just in the United States, that say, hey, there's a new potential technology in this country that could completely obviate the need for lithium. Maybe you need to look at something else. So it's a feed of those types of items with those initial analysis. And obviously, it's the building blocks of everything that we do here. It's the building blocks of my analysis, both with clients and with research. It's the building blocks of many of our investment theses. We want all of the companies we're investing in, or if we're buying bonds from a country or from all that stuff goes into it. It's the building blocks of it, and we're not telling you like what we're doing with the information. We're giving you access to that information feed if you want it. But that's the idea behind it. We're trying to show you. In some ways, I guess we're trying to show you our work, if you will. We're allowing you access to the things that we use to build our strategies, our consulting, all of these different things.
And then the deep dives, do you want to talk about that? Because that's an important part
sure.
of this.
The deep dives are just when we take a step back from something and say, you know what, like this deserves 800 words or 1,000 words. Because a lot of what's going on in the world, you don't have time to sit back and write sort of long things, and people don't have time to read long things. Time is really precious. It's at a premium. And readers of the Global Situation Report, and the Global Situation Report is just the little tip of the iceberg. It's me collecting some of the most important things on the Geopolitics knowledge platform from that week. We used to include sort of longer form in focus pieces in the SITREP every single week. We stopped doing that in part because it made it like 10,000 words long, and most people weren't interested in that. They just wanted the download of what was going on in the world. But those in focus pieces now live exclusively in the knowledge platform. So if you sign up for this research service, you are going to get not just that stream and the immediate analysis of what's going on. When we take a step back and say, hey, we want to look at how the geopolitics as an example of what we did just a couple weeks ago, or I guess I should say last week, we want to show you, hey, the geopolitics of Ireland is changing for the first time in literally a millennium. Irish geopolitics has never been this good before. Here's why, and here's why Irish home builders might be an interesting opportunity, might be in a place to have an interesting opportunity in the context of those geopolitical developments. So those types of reports are being generated there. I think we're going to average roughly one a week, probably. We're not sitting here saying, oh, we must put out one a week. But anytime something comes across our desk that says, hey, this needs to be focused on a little bit more, it's going to be in there. A good example is I can tell you right now, my next in focus piece is going to be about wheat. And we might talk about wheat a little bit in the context of the rest of this podcast, because you've got terrible weather conditions in the United States. You've got wildfires in parts of Russia and in parts of Siberia. You've also got Sudan's emerging civil war and lots of internal refugees, all these different problems around the world that could mean that we're finally putting in a bottom on wheat prices. I'm not quite sure yet, but if you're on the knowledge platform in about a week or two, you will see that I've sat down and sorted through all the intelligence and given you a thesis and a framework for thinking about that. So it includes all of those individual items, that stream of information, but every once in a while you will get a longer form focus on something that is particular interest. And it's the effect of the knowledge platform is also cumulative. It builds over time. So the more that we add to the database, the more valuable the database is, the more you can search backwards through time. That's one of the real features of thinking about the world through an intelligence lens. It's not thinking of it as, James Bond going to the party with the martini and, oh, I now have the information that I need to figure out what's going on in the world. Real intelligence methodology is really just cataloging a bunch of information, sifting through it for accuracy, sifting through it for legitimacy, and then trying to put together frameworks that make sense. It's a lot of reading, and the conclusions you can reach are very interesting, but the actual hard work, it's really hard work, and some of that work is really boring because you're reading 10 different things. Maybe only one of them is going to be important. So all of that is embedded within this approach.
And just a word on the connection, again, between geopolitics and innovation, because really we think of this in two ways. You mentioned the early stage innovation, and this is a concept that a lot of people understand, that early stage, really new disruptive innovations, they take too long for venture capital to care about. It's just not in their time horizon. So it's inevitably a non-economic actor. It's a government. It's a usually the Defense Department of whichever country, and to finance and sort of develop these. So looking at early stage technologies through a geopolitical lens is a big part of what we do. But also, once the technologies have been developed and they're being rolled out, which countries adopt and develop these technologies and build the supply chains around them is also inherently geopolitical. So to continue with the semiconductor example, like, why is Taiwan the biggest semiconductor maker in the world? Like, why the hell is this stupid little island off the side of China dominating the whole world in semiconductors? Well, for a very specific reason, that during the 1960s, when the semiconductor industry was just getting off the ground, Taiwan was worried that the US was going to abandon them. And they realized, they started forming deals with Texas Instruments, which at the time was this very nascent company. And they got Texas Instruments to come build plants in Taiwan because they figured the US military wouldn't allow China to come in and march into Taiwan if Texas Instruments plants were there. And that was the genesis. And obviously there's a longer story beyond that about Morris Chang and, their deliberate attempt to really provide the subsidies and the resources that they needed to build, this champion in TSMC. But that's all geopolitical. We wrote a piece last year for clients talking about the semiconductor materials and how Japanese companies and Korean companies were at loggerheads because of all these issues that you talk about. And that was a huge issue. If you were an investor in technology stocks and in semiconductors specifically, like, that was something that you needed to know. And that was inherently and purely geopolitical. This is something that you cannot avoid anymore. And we formulated this idea and we've really been rolling this out because we just kept bumping into this over and over again. Like, hey, geopolitics and technology are always on the same page of what we're thinking about whenever we're doing anything for clients or, making a certain investment or analyzing something. So this is the heart of that. There's a few different ways that we approach that. One of which, again, getting to the geopolitical side, is this notion of bottlenecks. So you have disruptive technologies, you have technologies that are growing in an exponential fashion. Where are the bottlenecks? Where do the inefficiencies show up? Where are the pinch points in the global system when things change really fast? So on our website, we just put our first, a report that you can download for free if you want to read. And it's about the subject of Iridium. And Iridium, to give this case study, because it's a good example of the sort of work that we do, Iridium is needed to do hydrogen production using PEM electrolyzers. So the vast majority of companies that are starting to build hydrogen capacity, they need Iridium to make that process work. And we won't get into all the details why. But Iridium is a very problematic substance. Not too many people are talking about this, but 85% of it comes from one mine in South Africa. It's a platinum or grade metal. When the mine went down for a few months in 2021, the price of Iridium went up like 150%. That is an awfully shaky hinge on which to rest the hydrogen economy that everyone has such high expectations for. And this is a subject that people are sort of ignoring. So this is an area where we really dug in. And when I say dig in, it's not us per se, we're generalists. But we've referred to this in the past, our innovation advisory board at Cognitive. This is people in industry, scientists, PhDs, who work specifically in these areas, who we consult with, who we work with directly to understand these issues and to dig into them, with people who know them backwards and forwards and can speak to the science. So that's an example of the sort of stuff that we're doing.
Well, and it's amazing. And I mean, this is a reflection of globalization and how successful globalization was in the unipolar world that most of us have lived in for the past, 2-3 generations, how many you want to count it. I mean, Iridium is not special from that point of view. Even things like, tungsten or tin or rare earths, you start to go down the list of where you get raw materials from, cobalt. it's usually from sort of one place in the world, and we optimize things so that you could get it cheaply from that one place and then move it out to the rest of the world. And I don't know if you've noticed this, like in the last couple of weeks, I feel like everybody and their mom is talking about the US dollar. And the dollar is a global reserve currency. And will the dollar fall a reserve currency or not? Like these types of arguments that are sort of these red herrings that don't actually matter about anything, like that's the nonsense. That's the noise. There's not one item in the knowledge platform about the US dollar going back 2 or 3 weeks. But what there is, hey, if we are deglobalizing, if we're looking at multipolarity and some of these really intense supply chains that everybody's dependent on right now, what does that look like? The United States and China might want to have a trade war, or they might want to fight about Taiwan, but China needs things from the United States it can't get anywhere else, and the United States needs things from China that it can't get anywhere else. So what does that look like, and what are the alternatives, and what other countries are they going to? And I think it's also we talk a lot about multipolarity and deglobalization here, and that's one of the big macro themes for me over the course of the next decade. The other big macro theme that really intersects with, and we're not even really talking now about the knowledge platform, but we're talking about sort of our framework for things, is the fact that we're going through an energy revolution and a tech revolution right now at the same time that we're going through multipolarity. So you made that point about the relationship between geopolitics and disruptive technology. It also doesn't have to be something shiny like semiconductors. Think about the rise of the British Empire. One of the reasons, and there were many reasons, I'm painting with a broad brush here, but one of the reasons the United Kingdom became a global empire was because they had a lot of coal. And because they had a lot of coal that was very cheap and easy for the United Kingdom to access, they were able to take advantage of the first industrial revolution in ways that other parts of the world were not. The shift from coal to oil begins to happen because the British Navy, with Winston Churchill leading the charge, says, you know what, we need to move our ships from coal to oil because we think oil is going to be the future. The problem was the UK didn't have a lot of oil. So the oil economy creates all sorts of geopolitical issues. It creates these kingmakers in the Middle East who have oil in the desert. If you look at a map of World War II, both European and Pacific developments, it's all about who's getting access to what raw materials and what energy as they fight those different wars. And what's happening right now is we are at the very, very beginning stages of moving away from hydrocarbons. So all of these different countries around the world are thinking about, well, what's the next energy source? Where am I going to get cheap energy from? And we could sit here and argue until we're blue in the face. Is it going to be hydrogen? There are countries like Chile and Japan that think yes, and that are betting heavily on that. Could it be nuclear? What we might talk about this a little bit later. Italy, which has been famously reticent to embrace nuclear, their Chamber of Deputies announced a motion this week to say, we want nuclear all of a sudden. Germany, we're now looking at you to take up the bandwagon there. The United States, we've got plenty of shale. So the United States is still thinking about the hydrocarbon economy. And there's Miles has been here. He's on our Innovation Advisory Board. He's talked about nuclear fusion. The point being, it's not just multipolarity and deglobalization. You're also getting this major energy tech revolution that's happening at the same time. And that's some of those concentric circles that we're talking about. So when we're thinking about all these different things on a macro level, those are things that are going to play out over a span of decades. Like I think we'll be having conversations about these issues for the next 5, 10, 15 years. But the other part of this is you have to see the forest, you also have to see the trees. And so every single day, there are little tiny incremental changes that you might not even notice that will get us to a place where in the future, you'll sort of say, oh, of course we were going to embrace nuclear. Of course we were going to embrace hydrogen. And I think oil is the real lesson here. Nobody knew in the 1880s or 1890s that oil was going to assume the position it was in the global economy. Oil was mostly used as a light source, not as something that was going to power warships or define the destiny of nations. But if you could go back in time and say, well, of course oil is going to be the thing that is going to do that. I'm going to buy shares of Standard Oil in 1900 in one of the nadirs. That's good. You could have made an entire fortune just on that one sort of decision. So the point there is that that's a really good example of figuring out that calibration between geopolitics and between tech disruption, and then getting your hands dirty and figuring out on a daily basis, okay, how do I ride these waves as they come up over years? Because it's easy to see the macro. It's easy to follow the things in real time. The hard part is making those things talk to each other. And that's what analysis is. That's in some ways what this entire podcast conversation is about. So I'll leave it there about the knowledge platform. If that interests you, and I'm expecting a lot of listeners, you just want the free sit rep or you just want the free podcast. It's not going anywhere. Don't worry. But if all of that sounds interesting to you, if you work at a company or at an institution or at a university where access to that kind of information or to this deeper analysis is useful to you, it's Jacob at cognitive.investments. I've said it in the intro as well. we'd love to talk to you. But otherwise, if you're just sort of, here along with the ride for us, now you know a little bit about what we do behind the scenes, and maybe we'll turn to the world in general. Rob, you joked about how we're usually the optimists, but you made some changes in the macro strategy this week that were not so optimistic, looking short at Germany and looking short at the United States. So tell the listeners why you're suddenly a Grinch over here, because you didn't sound so optimistic to me in our team Slack when you were putting in the trading orders earlier this week.
Well, that's why it's funny, because I am optimistic, and that's why we're short equities, which sounds weird. And let me explain. Everyone is used to, stepping back for a moment, people get used to the sort of environment that dictates, how you spend most of your career. And in most of our career, we've been in a deflationary environment. So going back to the 80s, when inflation started to come out of the system in the early 80s, and you entered the 90s and the so-called Great Moderation, you had financial markets and you had the economy behaving in a deflationary or a disinflationary way. First disinflationary, and then it went into deflationary after you get past 2002, really. And that, in those circumstances, financial markets behave very differently. Bonds go down when stocks go up, and vice versa. So, for instance, 10, 15 years ago, if the economy was slowing, if interest rates were going down, then stock prices would go down and bond prices would go up, because the assumption was, hey, we're going into deflation again, or like serious disinflation. That's good for bonds and it's bad for stocks, because in that environment, companies don't have enough demand. They've got too much supply. They're going to have to cut prices whenever demand slows down. So fast forward to today, and I think one of the biggest things that we disagree with the consensus, one of the biggest things we would say that we think is, fundamental to investing now and for the next probably 15 to 20 years at least, is that you have to take that whole disinflationary, deflationary mindset and just throw it out the window. And it's been shown that things are not moving that way. In 2022, stocks went down and bonds went down and inflation went up. That's what it was like in the 1970s. And this is a really important thing, because I think our sort of base case assumption is that the next 10 years is going to be characterized by very choppy, very brief cycles in which inflation is very volatile and averages much higher than it did in the past. And that's a really shitty environment for stocks. If you're going to go out and just buy the S&P 500 and expect that you're going to make 8% a year or 12% a year just sitting on your butt, that ain't going to happen. I'm sorry. And it has not been happening for the last year and a half, as some of these problems began to show their face. So that's a long-winded introduction to saying that part of the reason why we are short equities is because we're pretty optimistic about the economy relative to other people, which means that we think inflation is going to be higher than people expect. We think demand is going to be better than people expect. And if inflation, reaccelerates or is higher, then interest rates are going to remain higher. Businesses are going to experience more of a margin compression. A lot of this is not good for stocks, even if it's good for employment and, the money in individual people's pockets and things like that. So being short the market does not necessarily mean doom and gloom in the way that it once did. And I think that's a really important distinction to make.
Why did you pick, because when you said short the market, you picked the US and Germany as sort of your whipping boy. So why did you pick the US and Germany as the two areas that you wanted to be short to reflect this?
The US is really the big one, and that's about 3/4 or 80% of our short position. And the reason is pretty straightforward. US margins are way too high. If you look at what businesses had been doing, and we've talked about this isn't like some new development, but US corporates have seen their margins expand for the last 30 years, really. And that started to roll over starting around 2014, 2015. And then margins were in a downtrend That was interrupted when COVID hit. And when the government started giving out money to everyone, and when you had this inflationary surge that a lot of businesses got ahead of by raising prices ahead of their own costs, then their margins exploded again to all-time highs.
Mm-hmm.
And now you're seeing that start to bleed off. And part of this is just greater conviction that we have. You know, I mentioned to you before the podcast, I was like, Jacob, I don't know what's going on in the world because I've had my head so far into all these individual companies' earnings in the last week because it's the meat of earnings season. Well, you can see that happening. Margins are getting worse. Companies are not able to get ahead of price increases, or they're doing so in a lesser way, and the costs are sort of rising to catch up. So we're not optimistic that corporate profits are going to be really, really strong in the way that they have been in the last 2 years. And that's starting to play out, and the market looks very shaky, just technically. You can see this. A lot of stocks have already been underperforming. You know, the leadership of the market has been very narrow, which means only a few big stocks have really been outperforming. You know, put that together, and I think that's a good risk reward. We're not making some huge statement here, but that's our tactical view at the moment.
Okay. I think from there we can kind of turn to look at what's going on in the rest of the world, and it's been a pretty eventful couple of weeks, and it hasn't been one of those weeks where there's one thing that's captivating. There's just a lot of different stuff happening around the world, and you know, we could spend every single podcast talking about Russia, Ukraine, and about China and all these other things. And if you want to know about sort of the updates on that, look at the Global Sit Rep, obviously, or if you're on the Knowledge platform, you can look there. But there are a number of other things that I think it's kind of important to look at that are going on in the world. The first, and I'm not by any means an expert on this, and I've already asked Kamran to come onto the podcast, and he should be with us either next week or the week after. But Pakistan is a country with over 200 million people, which is circling down an economic catastrophe here. It's been reaching out to the IMF, and a technocratic government has been trying to cut spending and do all these tough things. We talked about Pakistan earlier this year because their government came out and said, we can't afford any of this LNG that's on the market, so we're just going to forget about LNG and go back to coal and other things like that. But it's been a particularly spicy week for Pakistan. Former Prime Minister Imran Khan was arrested by Pakistani security forces. His supporters hit the streets and even apparently started attacking army property and installations. And at that point, the Pakistani army joined the security forces and hit the streets as well. And you've got reports of deaths and fighting and clashes between protesters and between Pakistani security forces. We're recording here on Thursday. This will come out tomorrow. Today, the Pakistani Supreme Court came out and said, actually, Imran Khan's arrest was illegal and the security forces should release him as well. And if you read Pakistani papers like Dawn and some of the other mainline papers, they don't necessarily support Khan and some of his more populist measures, but at the same time, they don't like the look of the military sort of going into the streets. And I say all that to say, you know, this is a country of 200 million plus people. They have nuclear weapons. They're right on the border with India. This is the connective tissue between the Middle East and Asia. You know, probably nothing is going to happen here, but Pakistan has been simmering for over a year now. It started with those terrible floods that they experienced last year. The economy's been doing really, really badly. You put all of those things together, it's just not a very pretty picture. And I'm using Pakistan there as a stand-in because they're not the only ones without that pretty picture. So the other part of the world that I want to talk about here is East Africa. And let me get this right. It's the IDMC put out a report that showed that the number of people who were internally displaced in countries around the world increased from something like 38 million last year, in 2021 to last year, it increased to over 60 million. And some of that was the Russia-Ukraine war, but some of that was Somalia. Some of that was Ethiopia's civil war. Some of that was the Rohingya crisis in Myanmar and the coup there and everything that's been going on there. That's part of it. Some of it is the floods in Pakistan. And we can now add this civil war in Sudan as well. That's a massive increase in internally displaced people. And you've got some of those people, that's just internal displacement. That doesn't even talk about refugees who are streaming out of their countries trying to get from point A to point B. The UN warned in a report this week that as a result of fighting in Sudan, which doesn't look like it's any closer to being over. In fact, it looks worse. It looks like the military, which is stronger than the militias, is basically pounding the Sudanese cities with artillery and air forces and their air force. But the militias are doing classic counterinsurgency, and that's a recipe for for destruction and for high death counts and all sorts of other things that are terrible. But anyway, the UN report was expect another 2 to 3 million people at least experiencing food insecurity in Sudan, in a region where you've already got the Ethiopian civil war that just ended. You've already got a famine in Somalia that is maybe the worst in decades. You put all that together, there's refugees, there's internal displacement, there's food security issues. You start to put all those things together, and it looks like these little nerve centers in emerging markets are really not doing very well. And I think that's going to affect everything from commodity prices. For instance, I was just mentioning wheat. We talked about how, wheat prices have had a terrible year so far. If Sudan fighting is going to keep going, you put together some of these other crises, and we're going to have that kind of demand out there for wheat and other grains. Let's say the Black Sea Grain Initiative goes away too because of Turkish elections. Oh, well, suddenly things could get a lot worse there. A lot of these places too, they're not important from the perspective of global markets, but going to your point about bottlenecks, like Pakistan's in the Indo-Pacific, like that's a bottleneck. The Horn of Africa, the only reason anybody gives a crap about the Horn of Africa is because it's on some of the most important key maritime choke points in the world. So you start to put together these things. I think if something happens there and you see disruption in global shipping and markets change, people will come out and say, oh, it's a black swan. It's not a black swan. A lot of these indicators that I look for in emerging markets to find signs of trouble, they've been flashing, yellow maybe for 6 to 8 months, but now we're getting some red. I really don't like the situation in Pakistan. I don't like what I'm reading out of Sudan. So not very optimistic for me either right now.
Yeah, I hate to say that, we sort of predicted this when I think a year or two ago, we were talking about kind of big themes for a multipolar world and a world where, sort of globalization and supply chains are fragmenting and all this, because in places where there are problems, it does invite the problems. But other than leaving the humanitarian side over here, just thinking about how do you act in the world if you have capital to allocate and take care of or wealth to preserve, I think making sure that you're identifying which countries you want to be exposed to and which you don't is a really important part of that, because these issues, they crop up very fast, as we can see. So Pakistan has been on our do not go list as far as our country specific allocations go for exactly this reason, that there was the possibility of true disruption like this, and unfortunately that is seeming to play out.
Well, and I think one tangible way, whether you're just thinking about the world from your own perspective, whether you're a supply chain executive, whether you're an investor, this is one of the reasons that you should place such a high premium on institutions. And you can't, it's hard to get an indicator that says, well, how good are institutions in a given country? But a good example of what I'm talking about here is the example of Chile. So going back to really 2020, even 2019, when you had anti-government protests in Chile and they're going to rewrite the constitution, and then you had Gabriel Boric gets elected, and everybody's talking about, oh my God, the left is rising in Chile, and this is going to destroy everything. The reason that Chile is what it is because it actually has surprisingly robust and legitimate state institutions, which is actually relatively rare in South America and relatively rare in emerging markets. And that's one of the reasons that you think about Chile being able to moderate sort of the prevailing winds of domestic unrest that popped up because of, in the case of Chile, it was, people were upset that the government increased the price of public transportation. And that was the straw that broke the camel's back. Suddenly everybody was in the street and complaining about all the things that were wrong with Chilean society. But look at what Chile has done over the past couple of years. So this week we've got news that so they tried to get one constitution through. Didn't work. It was a shit show with all these different people. They had all these different resolutions that they wanted in. Everybody was covering the crazy resolutions. The ones that actually made it to the new constitution weren't so crazy, but it was the super. Anyway, they had a referendum and the population said, no, that constitution sucks. So now they're going back to square one. They're rewriting the constitution. They had an election for who was going to rewrite the Constitution and who wins more than 3/5 of the seats on this council, center-right candidates. So you've got, the center-left, Gabriel Boric is the president, and they sort of had their year in the sun. They couldn't deliver the goods. Now you've got this ping-pong back and forth to the center-right. The reason I say that is because when you look at media coverage of Chile, it's all about, oh, Gabriel Boric is a leftist, or, oh, he wants to nationalize lithium, or, oh, copper is at risk in Chile, and things like that. Yes, and those are all concerns and they're all risks, and you have to take them seriously. But Chile is the example of a country that has the sorts of institutions that can weather the types of issues that we're talking about that Pakistan and Sudan cannot. This is one of the reasons that Turkey's elections, which are coming up this weekend, we're going to do a rapid response on Monday with Emre to the results. We talked about it a lot this week with Ryan Bohl on the podcast as well. One of the reasons this election in Turkey is so interesting and important is we're about to really stress test Turkish institutions. So is Turkish democracy going to stand with all the pressure that's being put on it? My bullish take is yes, I think it will. Even if Turkish democracy isn't perfect, I think it's a democracy. I don't think that Erdogan's going to be able to just ride roughshod over Turkey if things don't go the way that he wants. The flip side of that, though, is, oh, well, if he does, then suddenly we have to question Turkish institutions. But that's why so much when you're thinking about geopolitics, one of the most important things you can really focus on is the health and legitimacy and status of state institutions. And countries like Sudan, like Pakistan, the reason they're risky, the reason that wonks like me will describe them as risky places is because you can't trust anything out of them. There is no rule of law. There is no stability. Institutions are extremely fragile. And in a world that is going to be more competitive, you're going to pay a premium for markets where you do have strong institutions or where you have governments that can make strategic decisions and pivot from one strategy to another.
I have a high-level question, which is, do you think that there is sort of a process whereby if institutions are pretty good for, a certain amount of time, that tends to self-reinforce? So I'm just thinking about Brazil, for example. You mentioned Chile, how, durably they've been able to get through their protests. And in Brazil, we had sort of a January 6th moment, which we talked about, and I think you did a special emergency podcast even to say, like, yeah, this is not going to be a big deal.
Yes,
and that turned out to be totally correct.
Had a few listeners point out that I always seem to do emergency podcast when I don't think it's an emergency, which I guess I need to do when there's an actual emergency, but yes.
But Brazil is an interesting example because, that's a country that's had multiple coups, hyperinflation within living memory. And yet there seems to be, because there's been a sort of institutional durability of some kind for 20 plus years, that seems to have solidified a little bit. And you can point to similar examples, like that, where countries have sort of weathered the storm a little bit more than you would expect. Do you think that that's how it works, where if you get things sort of right for a while, that has the sort of dividend that it pays, and people get used to stability, people get used to behaving in a way that promotes civil society instead of undermines it? Or is that being way too optimistic about how quickly these things change?
Well, so, you hit the nail on the head there at the end. Like, yes, the longer an institution is in place, the more durability it has, and the more that people come to expect that institution to be that way, and that inertia comes with its own strengths. But that doesn't mean just because there's been an institution that it will be there forever, and institutions can change very quickly. I mentioned earlier when we were talking about the knowledge platform, this idea that we've been developing about Ireland's geopolitics changing for the first time in a millennium. Well, one of the reasons is because Great Britain, which is sort of, the king of institutions, it's got the Magna Carta and institutions going all the way back. British institutions are starting to look a little bit brittle. They're making decisions like Brexit, and they're actually fumbling some of their advantages as the English-speaking gateway to the European world. And suddenly Ireland's political institutions, which have historically never looked that stable, look more stable than British institutions. In the UK, we've had Rishi Sunak and Liz Truss and the head of Lettuce and Boris Johnson. Compare that to recent Irish governments over the past 20 years, which have been mostly moderate, where you haven't sort of had these extremes and had these major policy snafus and things like that. And that could open up opportunities for Ireland. So all of that is to say, institutions can be attacked, even if they've been around for hundreds of years, but it is really, really hard to kill off an institution if it's durable and if it's been there for a long time. The flip side, and this is where it's really hard to benchmark opportunities, is where are you going to see places where institutions are beginning to strengthen? So this is your point about Brazil. Up until the 1990s, Brazil really didn't have stable political institutions. All it really had was the army that came in and did whatever it wanted when it needed to. Well, now the army seems to be safeguarding democracy. Now when Lula or Bolsonaro goes and runs their mouths about monetary policy, the Central Bank of Brazil, I loved their minutes this week, came out and said, no, we must approach inflation with serenity and calm. Like, they're not scared of Lula and Bolsonaro and all these other things because you've got this kind of support. Mexico is another really good test case. Mexico doesn't have very good political institutions. To the extent it has institutions, it's been the Mexican military and armed forces is relatively respected. And that election sort of overseeing group that AMLO has gone after here in the last couple of months, that was another good political institution. That's now under attack. And we're about to see just how stable Mexico's political institutions, which it's built up over the past 20, 25 years, are actually going to be. So that's my way of saying, like, that's a very long-winded, circuitous answer to your point, which is yes, institutions have durability the longer that they've been there, but that doesn't mean that things can't change very quickly. And it doesn't mean that you can't build institutions very quickly. But yes, in general, time and durability is something that is good when it comes to thinking about political institutions. Speaking of institutions, let's close with a couple thoughts on something that if our podcast producer wasn't literally pinging me every day that we needed to address this topic, I probably wouldn't even bring it up. I think we should talk a little bit about the U.S. debt ceiling, because it looks like, you know, the House and House Speaker Kevin McCarthy is going after the White House, and they're talking about actually enforcing this debt ceiling, and it's out there as a big fear. I think, in markets. And I just wonder, Rob, if from your perspective, is this something that you're worried about? I've sort of said here in the past that it doesn't make sense for the United States to have an issue like this because it's all downside, but just because it's not in U.S. interest doesn't mean it's not going to happen. We just saw from Russia how much countries will do things that are not in their interest because a leader thinks something is wrong or because of internal political dynamics. But I just wonder if you think the debt ceiling issue, or maybe we could even tie this to the U.S. immigration issue and Title 42 and all these other things, if that is something that is concerning you about the state of U.S. institutions, and if you think the market should be worried about the debt ceiling debate that's out there.
Well, I think there's two ways you could tackle that. The first is from a financial markets perspective as an investor. And the second one is longer term, because, you know, just this morning I got an email from a client saying, hey, I'm really worried about the dollar. Can we have a discussion to talk about what's going on? And that seems to be the zeitgeist, as you pointed out. Everyone's concerned about that. So let's take each of those in turn. First, on the investment side, which is more tactical. So we've had multiple meetings specifically to talk about this internally and just make sure that we understand what's going on. And essentially, the way that we're positioned right now, in full disclosure, is we have a big position in short-term U.S. Treasuries, T-bills. The yields on T-bills is really good right now. It's over 5%, 5.2% in that area. And the concern is if you do have a debt ceiling breach and you have a technical default, then the duration that you'll get on those T-bills, you'll have to wait a little bit longer to get them paid. But for most people, it doesn't really matter. Like, even if it's delayed a month or two, for all intents and purposes, it's the same thing. If they do have a debt ceiling breach and they have a technical default, you probably will see at least a modest sell-off in stocks and risk assets and credit spreads and stuff like that. It's a little bit hard to dictate or to predict, because the notion of the risk-free asset is so ingrained in all finance theory that if the risk-free asset, even if it's just a technical one, has a default, it's sort of a little unpredictable. It's sort of like building all your institutions on the understanding that there's gravity, and then gravity turns upside down and everyone's flying up to the ceiling. So Right. There's a little bit of the unknown unknowns, but I think for the most part, it's fairly mild, any actual ramifications in the short term. So that's how we're positioned, and that's sort of our take. In short, not a huge deal. The bigger question that I think more people are interested in is, well, is the dollar losing its reserve currency status? Is the dollar becoming weak? And this is, I think, an area just that's so ripe with misunderstanding, misinformation, because it's so unintuitive, some of the key aspects that drive the dollar strength. So let's just break out some of those and talk about them, right? So first of all, I'm going to bring up the name Michael Pettis, and we're going to have an argument right now. But
no, I like Michael Pettis. It's good.
Just for background, Jacob and I have been having a lot of discussions about Michael Pettis recently. But I think he's right in pointing out, and I really like Michael Pettis too. He's right in pointing out that the dollar strength is not necessarily a good thing. It's not necessarily a sign of, oh, the U.S. is so healthy and that's why the dollar is strong. And therefore, if the U.S. is not healthy, if you have people storming the Capitol building, if you have a technical default, that the dollar is going to be necessarily weak. The dollar is strong because we are the only country that's big enough and liberal enough in accepting capital from abroad that you can put your funds here. So, for example, right now, people with money in all of these countries that we spoke about, Sudan, Pakistan, they're desperate to have dollars. They're desperate to get their money out of those countries. And if you put that together, where are you going to go? What are you going to buy? In aggregate, the US is the only capital market that has the depth to accommodate the flows of people who want to have a reserve asset. The bigger thing is not individuals like that, it's states. So states like China and Japan that run chronic current account surpluses, so trade surpluses, they run those trade surpluses because of policy levers that they've pulled in their own economy. And as a result of that, they need, we always think of the current accounts in terms of the trade side. Yes, they export more than they import, but the corollary of that by necessity is they have flows of capital that they need to shoot outwards like a fire hose. So who's going to accept that flow? The United States is the only country that can and will. We're the only country that's big enough. We're the only one with liquid financial markets. Even Europe, arguably from a GDP basis is about the same size as the US if you take Europe as a whole. But the way their financial markets are structured, you have German boons, and then, very quickly you run out of kind of safe stuff to own, or liquid stuff to own, because Europe has a lot of debt. A lot of it is owned by the ECB. Or it's in countries that are kind of, you're like, well, that's a little weird. I don't know if I want to own so much Italian debt, for instance, right? So the whole point is the U.S. dollar strength is the outcome of the global system that we've lived in for several decades now. Those countries are not going to turn around. Like, everyone always assumes it's like a moral story. Like, oh, are they going to punish us by not buying dollars anymore if we're too stupid, or we shoot each other too much, or we burn down the White House? No, they're not going to, because there's no alternative. And I think that's really so hard to wrap your head around. It's not a moral story. It's not a judgment call about the U.S. It's an equation, a mathematical equation, and the only potential outcome after the equal sign is buy U.S. dollars. And until something fundamentally changes, and it probably won't be on the U.S. side, it'll probably be on the other side. So, some fundamental shift in the Chinese economy, where they're no longer running structural current account surpluses, where they change policies to kind of durably consume more, which isn't on the horizon, but at some point they probably will have to, because it's not sustainable otherwise. That's when the dollar will fundamentally change. But in the meantime, all of this stuff, we can do lots of crazy things, and the dollar is not going to suffer as a result of it.
Well, you were talking about the 1970s at the beginning of the podcast. One of my favorite charts to show people when I'm on the road is, look at dollar strength over the past 10 years. Looks like it's been going up quite a bit, but then look at the dollar strength going back to the 1970s, and we're relatively low compared to we were in the 1970s. So like when you think about there being room to run, there was an interesting article. I don't know if you got a chance to see it on Knowledge Platform yet, because I just put it there this morning in Nikkei this morning, which had two major Japanese life insurers were talking about cutting some of their actually U.S. treasuries and buying Japanese government bonds instead. And that was interesting for a couple different reasons. It was interesting because that was actually, two top executives at major life insurers in Japan saying maybe the Bank of Japan is going to change monetary policy over the next 12 months. I think people have been anticipating that change a little bit prematurely, but now you're getting to see little voices within Japan itself saying, maybe we're going to get some kind of change in monetary policy, and even thinking about strengthening of the yen in general. That one sort of stuck out to me because that, to your point, there are not like large enough liquid markets out there that can handle all this other thing. But Japan is one of these states that has a lot of interest in U.S. treasuries, and just an article about maybe life insurers thinking about, no, we're going to go U.S. corporate debt, or we're going to go Japanese government bonds rather than U.S. treasuries. I don't know, that stopped me, and I just sort of thought about it for a minute. Does that relate to what we're talking about here, or am I making a mountain out of a molehill?
It does relate. It's a tricky thing because in the case of the Japanese insurance companies, so much depends on the costs of hedging out their currency exposure. Yeah. And that depends on what are people's expectations for what the currencies are going to do, because that determines what your cost to hedge is. So I wouldn't read that as, we fundamentally are scared of the US and we think the Japanese, bonds are suddenly much more attractive, because they're not. And you can see that in what they're saying. If you thought that the BOJ was going to normalize policy, why the hell would you go out and buy Japanese long-term bonds trading at 50 basis points if you think, in 6 months you can go out and buy them for much less than that, or, for much less in price, much higher in yield. So I think Japan is always a weird case because they have such a huge position, and a lot of the actors that they have are economic actors. Taiwan is similar. So Taiwan has a huge surplus position, most of which is sort of intermediated through insurance companies as well. Whereas, China, for instance, has much more in the arms of, state-controlled bodies, which give, less consideration to, the economic return on their holdings. So yeah, it is relevant. On the Japan thing, not to get off the dollar, but just on Japan specifically, because I think it's an important thing to note. I would imagine that these guys are saying that and they don't really believe it if they really are, shifting into Japanese bonds. And you can see just this week, so we've talked about this in the last few months, how so much depends on these Japanese wage negotiations in the spring. Like, are you starting to see this self-reinforcing inflationary spiral, which would be good? That's what they want. That's what they've been trying to engineer for so long. And actually this week you had a pretty disappointing data point on the actual wage increases coming out of Japan. They were only 0.8% in I forget if that was real or nominal, but it was meaningfully less than the government and some of the more bullish observers were hoping for. So that makes it less likely that they're going to normalize monetary policy anytime soon. As far as the yen goes and yen strength, this is a very interesting one. And I don't have a strong view either way, but here's the setup. The yen has been strengthening for 30 years, 35 years. Which is sort of the natural state of a country that runs current account surpluses all the time, which Japan does. Like, if you go back to, David Hume, countries that run current account surpluses, they're supposed to heal themselves naturally because the currency appreciates, and that causes exports to become less competitive. And, because if someone is buying your stuff, they're getting your currency. And that's sort of what you've seen in Japan, except if you take, there's been periods of where the dollar has been really strong against the yen and the yen has weakened again. But if you look at the chart of the Japanese yen going back 30, 40 years, that downtrend that we've been in, where the yen has gotten stronger and stronger and stronger and squeezing higher against the dollar, that's kind of broken. And that's a really interesting development. So the yen today is, around 135 to the dollar. That represents a break of this big trend that we've seen. And if you just look technically, like, it looks like the dollar could really go much, much higher against the yen. In the 70s, the yen was 350 to the dollar. I don't know if it would go back there, but it just doesn't look like we're going to have some period of, extended yen strength. It looks like something is broken.
Well, on that note, I think we've been going for a while, so we'll come back at you next week, listeners, and thank you for your patience. And until next time. Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.